Good morning. Welcome back to the Broadcast Retirement Network. This is BRN AM for Thursday, March 28th, 2024. And our top story today is life insurance taxable. And joining me now to discuss this and a lot more, Philllip Snyder is a senior vice president at the Warner Companies. And full disclosure, he's also my father. Dad, so great to see you. Thanks so much for joining us on the program this morning.
As usual, it's my pleasure, Jeff. Good morning to you.
Yep, spring has sprung, and right around the corner, Dad, it's the IRS tax deadline. Thought it'd be good to talk to you about taxation when it comes to insurance claims.
Okay.
All right, well, that's good. At least I passed. I wasn't rejected by my father. That's good. All right, Dad. Let's start with some basic questions. Is life insurance taxable to the recipient? So say someone passes away and you file a claim and get money. Is it taxable, and therefore should it appear on your IRS Form 1040?
The general answer to your question, and then I'd say 95 to 98% of all circumstances, the insurance proceeds paid at death are income tax free.
Okay, so that's a good.
There are exceptions to the rule, but they probably go into the weeds a little bit. But by and large, life insurance paid to a named beneficiary is income tax free.
Okay, I don't want to unpack the kind of the minutia in a second, but does this mean that if you have a term life policy or a whole life policy, they're very different. We've covered them on the program before in terms of how they're structured. In both instances, generally speaking, the recipient, the beneficiary, gets paid the claim tax-free. It's tax-free.
That's correct. Doesn't matter on the type of life policy. The proceeds are payable on an income tax-free basis.
All right. So, okay, that's good to know. And I think anybody this year who's filing with the IRS should know that. Hopefully they would know that, because do you get a 1099 of some type at the, I've never claimed life insurance, not obvious, but I've never claimed a life insurance policy. So do you get a 1099 for getting the money, and does it have a certain code on it?
Well, the insurance proceeds being tax-free, you'll get a statement from the insurance company that supports that payment. The only time you'll find the 1099 interest reported is where the insurance proceeds are held for a period of time by the insurance company beyond the date of death until the settlement is reached. So I have one now going on where it's about 2.5 months since the decedent actually passed away. We expect the proceeds this week. It's been a slow process, unfortunately, but they'll receive interest on those insurance proceeds from the insurance company. That's a taxable event to the policy owner.
So that's good to know. And so that
to the beneficiary. Excuse me.
Yeah, that's what I meant. Well, the policy owner, he or she doesn't care, because they're in the next life. But Dad, in all seriousness, so when is that the only example where life insurance could be taxable to the beneficiary?
Well, no, there are rules. They're complicated rules. They're called transfer for value rules, and they go in depth into policies that have been transferred from one owner to another owner. That can happen in business. It can happen through gifting. Those, depending on how the nature of their transfer and how it was handled, that could change the tax structure negatively to make a portion of those proceeds taxable. But most professional insurance brokers, certainly the client's other advisors, if they're involved, would realize what those transfers were or are, and you would avoid them if possible.
But probably a little bit. Yeah, I mean, it sounds like it's very complicated. It's a very complicated type of transaction that maybe happens on a one-off, but for those of us who are part of the general population who perhaps could be recipients be beneficiaries, we would generally pay no taxes.
For the most part, that's true. Right.
And would any of that change? I know there's been some talk in the Congress about, or at least the president talked about, some changes to tax policy. Would any of that, based on your knowledge, and you're not intimately involved with Congress, you're involved with several organizations, but would any of that change or look to change over the next year based on what you heard in the State of the Union?
I think not. That's been kind of sacrosanct for I don't know how many years, long before I came on the scene. Insurance proceeds payable to a named beneficiary are income tax free, again, generally speaking. So I don't see that changing at all, but who knows, you know?
Yeah, you just
The
don't never
government
know.
appetite for revenue could delve into anything, who knows?
Yeah, and on the retirement side, I mean, we know that it always comes up and you've seen this in the popular press, the 401k tax deferral status that has come up recently as a way to meet some of the budgetary changes, and I would argue that separately from what we're talking about that that would be a detriment to the retirement industry and to people saving for retirement. But we can get into that in a different show. Dad, I want to take a very quick break. When we come back, we're going to talk about how much life insurance do you actually need? You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Well, Dad, thanks so much for staying with us. Really appreciate you hanging around for segment number 2 this morning.
All right, Jeff, my pleasure. Thank you.
All right, and I feel like this topic that it comes up regularly with you and others that we feature on the show. How do I figure out? I'm a young man, relatively young, maybe young relative to some, not young relative to others. How do you figure out as an individual how much life insurance you actually need? So forgetting term life, whole life, forget the vehicle, but let's talk about how much you actually need at different points in your life.
Okay, well, if you're buying a life insurance policy or you intend to buy a life insurance policy, for the reasons of creating monies at your death that will be used by others who are in one way or another dependent upon you, then that's the mode that I think you're interested in discussing now, as opposed to life insurance as an accumulation or supplemental retirement benefit or things of that nature. So
Yeah,
by
go
and
ahead.
large, you have to sit down, and most insurance brokers and companies who are in that marketplace will have guidelines and forms to help you to jog your memory, to write down things you might not otherwise think of. But by and large, if you're let's say you're a young family, wholly dependent on the income produced by one or both spouses, and you have a couple of young children, then you're going to want to add up all the exposure you have. That could be a mortgage. That could be other debt obligations. It could be education expenses. It could be lost income over a period of years that you can project out over time. And really what you want to do is add up all those items. If you're capable, discount them to a present value. For example, if I'm going to make $50,000 a year for the next 20 years with some level of interest, you can distill that down to a value today. and figure out what that number is on a present basis. And when you add up all these exposures and obligations that you have, then that can give you an indication of how much insurance you may want to consider buying. But you also need to consider what other monies might be available to me. What other insurance do I have? What other assets do I have that could be employed to meet some of those obligations? What inheritances or other monies am I likely to receive over time? So it takes a little work to do that, but that's the best way of doing it. Just figure out what are my exposures, what are the risks to my family, and what can I do through insurance to make sure that if the worst happens, that those obligations will be paid off.
So, Dad, you do that calculation or set of calculations, and there are plenty of worksheets. First of all, you can probably do it with a competent financial advisor, but you can also do it on your own. They're online or through Microsoft Excel, I'm sure, or whatever the competitor it is, because Microsoft's not supporting the show. But
it just takes a little time and effort.
Right. So you come up with a number, and then is that, so let's just say it's $500,000. I'm just making it up. Maybe it's 250. Do you take that number that's at the bottom of the spreadsheet and you go to the insurance broker and say, this is what I need? So once you get that number, what do you do?
Well, assuming you've derived an amount, rightly or wrongly, but you've derived an amount that you're happy meets all the obligations that you've laid out. Then the broker will help you determine the type of insurance you should buy, and that's based on a number of things, including your ability to pay premiums. And the broker will then help you obtain the policy through the companies that he or she represents. It's really just as simple as that. For young people, buying life insurance is relatively simple today because in many cases, you don't even need a medical exam. You can do all these things online in a simplistic manner. So it's not really that difficult. The hard part is making the commitment to do it. Drive yourself, and I can tell you stories from my past years ago where some people were highly interested, other people were totally indifferent, didn't care. So you've got to get motivated people who to do the work, which isn't a big effort, but it involves creating a thought process. And once you know all the items that you should consider, then it's relatively straightforward from there. Having said that, and once you implement the coverage, then over time you have to monitor your plan. See what's changed in your plan. Has your income changed? Have your obligations changed? Did you have another child? Did you incur some additional debt? Did you buy a second home? Things of that nature. So it's always a process, but it starts by putting everything together that would be required in the event death occurred that day.
Yeah, and it's just a time commitment that it's a time commitment, but once you get it down, now it's just about continuing to check in. Dad, what if you're a single person? So you mentioned family. What if you don't have a family? What if you're just a single? There are a lot of single people out there. Maybe they have benefits. Maybe they have all the things you talked about. But one thing you didn't mention is burial costs. They're high. They're expensive, depending on what your preference is. Whether you want to be buried or whether you want to be cremated or some,
Right.
other earthly means.
Those are relatively small expenses for people who are considering buying insurance to protect their family, and you can add those in. That's relatively simplistic. If you're a single individual and you have no obligations, chances are you really don't need to buy life insurance from an income production standpoint, producing money for others. But you may want to buy life insurance and leave it as a gift for your nieces and nephews. You may want to make a charitable bequest of life insurance. So there are other uses for life insurance. You really need to define what your objectives are.
And Dad,
go ahead.
Go ahead. No, finish. Go ahead.
If you're a single person, you may want to buy life insurance as a cash accumulation vehicle for future use, post-retirement or whatever. So there are a lot of things to consider. And that's why you have to go through the process of talking with people so they take everything into consideration. And that's how you sort of back into it or develop a number, as it were.
And you mentioned inheritance. Not everyone gets an inheritance. What about something like Social Security? So, Social Security has a death benefit if you're married, right? So if I pass away, then my spouse would get some calculated benefit. So part of it is figuring out a budget or what you need to cover today and in the future. But also, when you look at those revenue sources, retirement, your personal savings, inheritance, Social Security, what else am I missing?
Other investment plans, real estate, businesses you may have an involvement with or own. All those things have to be pulled together and taken and built into the equation to figure out what am I really trying to accomplish and how am I going to accomplish it. And if I'm looking at life insurance as an accumulation vehicle, then you want to factor that in. You probably want to maximize some pre-tax opportunities that you might have, 401ks, things of that nature. Maybe your company, if you're an executive at a high level, your company may allow you to defer income through the company and derive and take it later as a post-retirement benefit. So every situation is different, and people view things differently. So you really have to get to know your customer or your client, as it were, excuse me, and then go from there. And
Now,
no two are alike.
now a lot of and right. I mean, we're all individual humans with our own separate needs, and a 50-year-old like myself, or 50, soon to be 52, may be different than another 52-year-old with the same male, 52, no family, etc., or just a wife. Last question I was going to ask you, and I just kind of forgot it, but I'll just throw it out there. Oh, I know what it was. Tax premium. You pay your premium, or premia, I guess is the plural.
Premiums is fine.
Well, the premium. Well, anyway,
Right.
we'll have a grammatical show later.
My old Latin years, right?
Yes.
But go ahead.
Okay. But is that premium is made after tax?
Correct.
And it's not pre-tax, correct?
That's correct. Life insurance, other than where you have an employer paying a premium to provide a benefit for you as an employee, as an example, the employer then would get a tax deduction for that premium, but you'd have to pick the premium up as income, ordinary income. But apart from those types of situations, if I buy life insurance, you buy life insurance, you're buying it with after-tax dollars.
And that's why, just to go back to our first segment, it's a tax benefit. It's tax free when you're paid the benefit, right? I mean that is essentially why you're paying premiums after tax, and therefore it earns some amount of money over a period of time. But that's why it's tax free.
Yeah, there's one other very important attribute that applies to what we'll call permanent or cash value types of policies, whole life, universal life, the whole genre of policies, is that money in those policies grows on a tax deferred basis. So as the cash value grows, or as interest or investment gains are added over years, they're not taxable as long as those funds remain in the policy. And without complicating it even further, there are ways to take funds from those policies, let's say as a post-retirement supplement, on a tax-free basis. So those are some planning things that probably go beyond this initial conversation. So that's one of the inherent advantages of a life policy. You can build money over time. You put money in after tax, the money's payable, you're death tax free. But in between, the money that's growing in the policy, now this doesn't apply to a term policy by and large, but any type of quote unquote cash value policy, that money grows on a tax deferred basis and can be accessed later on an as needed basis with potential very favorable income tax implications. So
that's good to know.
That's complicated.
That is complicated. I think we lost half the audience, but that's okay.
Well,
you didn't lose me, but I think, look, it's important. People need to understand the basics. I think we effectively did that. Dad, we're going to have to leave it there. I sense that we'll be bringing you back on again very soon to talk more about life insurance. Have a great rest of your day, and we'll talk to you again very soon.
All right, Jeff. Thanks so much. Hope it was helpful. Bye now.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Well, then visit our website. We're not back tomorrow. It's Good Friday and the markets are closed, but we will be back on Saturday for BRN Weekly. I'll be sitting down with Jane King, who will join us from the NASDAQ, and then we'll be taking a look back at some of our best segments for the week. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.